welcome. This is Business at 9. I'm Shabani Gharat, and joining us is my colleague Jude Sanit. Now, let's quickly take a look at how the U.S. markets are faring this Tuesday. In fact, Wall Street indices, S&P 500, Nasdaq Composite, and Dow Jones Industrial Average traded around flatline. The moves come in as oil held steady amid uncertainty over the West Asia conflict. Nvidia shares kept the S&P 500 afloat, rising around 1% after companies said it's partnering with 6 large asset managers to mobilize more than $500 billion for artificial intelligence infrastructure.
Meanwhile, as uncertainty looms over the deadline to sign the Iran-Oman deal for Hormuz, U.S. President Donald Trump is now demanding compensation from Iran for the alleged killings of U.S. citizens by the country over the last 45 years. Now, this comes after Iran demanded that the U.S. pay compensation for the 5 months of war. My colleague Sumita joins us with more on this very important geopolitical update.
That's right. US-Iran peace talks have seemingly stalled as now the sticking point is about the ownership and the reopening of the Strait of Hormuz. Remember, it has in fact emerged as a key sticking point in all of July, right after that MOU was signed between both the sides. Now, President Donald Trump has added a new dimension. He's added a new demand, and he says that Iran should be paying compensation to the US for all past damages and conflicts. And he says that all the alleged killings that have happened of US citizens by Iran in the last 45 years, they should pay repayment for that. And this, he said, after Iran said that the Strait of Hormuz is going to remain closed until the United States lifts its naval blockade and sanctions along with military pressure, and unless Washington agrees to pay war reparations and end sanctions that it has levied on Iran. The Iranian side is, of course, saying that the demands are largely in line with the terms of the interim peace agreement, which was signed in June, remember, which is broken down over the dispute over the control of the Strait of Hormuz. Meanwhile, the Iranian Foreign Ministry spokesperson Ismail Baqai has told the state media that talks with Oman were progressing smoothly and constructively. And in fact, he also said that an agreement could be reached on shipping route map, while some technical issues, they still remain unresolved. Meanwhile, what's also happened is that the Iran-backed Houthis have launched renewed attacks in Yemen, and that has really added to the pressure on the Red Sea, on the Bab al-Mandab shipping route. And of course, shipping data, meanwhile, does confirm that traffic in the waterway had dropped sharply over the weekend.
Right. Now, ET Now sources say Sir Ratan Tata Trust trustee Vijay Singh has stepped down. The development comes as the trust has been facing regulatory hurdles. In May, the Mumbai Charity Commissioner barred SRTT from holding meetings or taking important decisions pending a probe. Following Singh's exit, 5 trustees, including Noel Tata, remain on Sir Ratan Tata's trust. We have Anurag Joshi here with more details.
Vijay Singh has stepped down as a trustee of Sir Ratan Tata Trust. His term was due to end on August 14, but he will remain a trustee on Sir Dorabji Tata Trust, which is the other key trust. And they both, Sir Ratan Tata Trust and Sir Dorabji Trust, they hold a majority stake in Tata Sons. After Singh's exit, there are just 5 trustees which are remaining on Sir Ratan Tata Trust, and this includes Chairman Noel Tata. Singh's departure is amid restrictions that have been imposed by Charity Commissioner on SRTT. In May, the Commissioner barred SRTT from holding meetings or taking important decisions, and SRTT can't hold meetings until a probe, which has been ordered by the Charity Commissioner, is completed. A complaint was lodged with the Commissioner's office in April, in which it was alleged that Sir Ratan Tata Trust had violated the Maharashtra Public Trust Act and the rules relate to having more than 1/4 of the total trustees as perpetual trustees. And Sir Ratan Tata Trust is now seeking permission from the Charity Commissioner to at least hold the important meetings, saying that its decisions regarding disbursements for key charity causes is at risk.
Meanwhile, the Securities Exchange Board is seeking stakeholder views and allowing FPIs to participate in non-agricultural commodity derivatives. The proposal includes non-cash-based contracts and a 2-tier safeguard. My colleague Anurag joins us again with more details on this.
Markets regulator Securities and Exchange Board of India has released a consultation paper on FTI participation in exchange-traded commodity derivatives. Sebi has sought stakeholder views on FPI participation in non-agricultural index derivative contracts, and the comments sought on the FPI participation in non-cash, non-farming commodity derivatives. The stakeholders need to reply to SEBI with their comments by September 1, the market regulator said in a statement. The Commodity Derivatives Advisory Committee has recommended that FPIs may be allowed in non-agricultural index derivatives, and SEBI has proposed that FPIs may take position in non-cash based non-agri commodity derivatives at domestic exchanges, and has proposed a layer or two-tier structure safeguard. SEBI, the FPI is keen to trade non-cash non-agri contracts shall enter into a tripartite agreement, and a bipartite agreement is also possible with trading and clearing members. The exchanges with commodity derivatives will standardize the format and also the material terms.
Right, now moving on, Fitch Ratings has affirmed India's sovereign rating at BBB with a stable outlook, citing the country's robust growth outlook, solid external finances and improving macroeconomic stability. Fitch says continued high growth could strengthen India's economic resilience and gradually improve debt metrics. However, the ratings remain constrained by high fiscal deficit, elevated government debt and debt servicing costs, along with weaker governance indicators and lower GDP per capita compared with similarly rated peers. My colleague Akanksha brings us more details.
That's right. Fitch Ratings has kept India's sovereign credit rating at BBB- with a stable outlook. Fitch says India's strong growth outlook and solid external finances continue to support the rating. The rating agency has also said that India has strengthened its track record of maintaining macroeconomic stability and improving policy credibility. According to Fitch, strong economic growth should make the Indian economy more resilient and could also help bring down the government's debt burden over time. But on the other hand, there are still some concerns. Fitch says India's fiscal deficit remains high and government debt and debt servicing costs are also elevated compared with other countries with a similar rating. Now, the ratings agency has also flagged weaker GDP per capita and governance indicators as factors that continue to constrain India's sovereign rating. So overall, Fitch remains positive on India's growth story, but says the government needs to continue with fiscal consolidation and bring down debt for further improvement in the sovereign rating.
Well, on that note, let's take a look at how the markets fared today. It was a weak Tuesday with the Nifty falling below the 24,500 mark. The Nifty Bank fell for the third straight day, while mid-caps ended flat and small caps relatively outperformed. In fact, the pharma index surged over 1%, while FMCG was the top sectoral loser. Dr. Reddy's was the top Nifty gainer, while Tata Consumer and Nestle came under selling pressure. My colleague Snehi joins us with more market updates.
Well, yes, yet another subdued day of trade coming in for the market. On the spot, we ended the day with a cut of close to 0.5%, and 24,471 is where we've ended for the day. Yes, we've seen a nominal recovery coming in from the days though, but nonetheless, it's a cut of 110 points on the spot. Sensex too lower by about 0.5%, and it's a 390-point cut coming in for the Sensex as well. However, the Nifty Bank, that recovered sharply from the day's lowest point. At one point of the day, we were lower by about 0.8%, ended with cuts of 0.4%, and the 250-point cut coming in on the Nifty Bank too. However, for the broader end of the market, the picture was slightly different, because while the mid-cap index was nominally under pressure with a hint of a negative bias, the Nifty small cap has done marginally better with gains of about 0.2%. Taking you through what the sectoral moves have looked like in trade, you had pharma, IT that were shining really bright, so the defensives were holding well, along with a little bit of a positive move on oil and gas, with PSU banks being absolutely flat. From the pharma pack, it was Gland Pharma that led the gains, good and strong Q1 earnings, 10% uptick on that stock. Zydus Life was the other one, second gainer from the pharma index on the back of strong earnings, a 6.5% uptick, followed by Dr. Reddy's, Ipca, Divi's, Abbott. All of them have done really well. On the flip side, the other defensive name, that's Nifty FMCG, was surprisingly the biggest loser on the street, with a cut of 1.25%, led lower by Tata Consumer, Nestle, Imami, Varun Beverages, ITC. Then following that, you had Realty, Metal, Auto, Defense, Finance, Media, and Nifty Bank that saw some cuts in the trading day. From the broader end of the market too, the tilt was towards the declines. You had 300 stocks in the red and 200 in the green from the Nifty 500. Triveni Turbine was one of the biggest losers on weak earnings, followed by KEC International, Balrampur Chini, ABFRL. Earnings reaction playing out for a second straight day on ABFRL. All of these were buzzing in the red on the back of weak earnings. But on the flip side, Finolex Cables, very strong numbers, 15% uptick over there. You had some upstream oil companies on the back of crude prices being elevated at around $90 a barrel. You had Chennai Petroleum, MRPL, Oil India that did wonderfully well, followed by an Amara Raja. QSR stocks like Devyani and Sapphire have continued to do well. So that was the tilt of the trade in the broader end of the market. Even for the CAS segment, that's the closing adjustment segment, we did not see much momentum coming in on the market. The Nifty continued to stay absolutely flat with a movement of just about 20 to 25 points in the CAS. Nonetheless, we've ended the day under pressure for a second straight day, and that's the kind of Nifty expiry play out that we've seen coming in for the day of trade.
Shifting focus to some boardroom developments. Now, GCPL's MD and CEO Sudhir Sitapati has resigned from his role just months after he was reappointed. Snehi Shah joins us to bring us up to speed with all the developments.
Well, yes, there's been a surprising change of guard at Godrej Consumer Products because the current MD and CEO, Mr. Sudhir Sitapati, has tendered his resignation. In his place, the current global CFO of the company, Mr. Asif Malbari, is going to be taking charge. This is with effect immediately, and Mr. Vishal Kedia is going to be appointed as the interim CFO because the CFO is now becoming the MD and CEO. A little bit about Mr. Sudhir Sitapati's resignation. Why this is surprising? Why do I say this is surprising? Is because not very long ago, on the 6th of May this year, the board had approved the reappointment of Mr. Sudhir Sitapati for the next 5 years, all the way up to October 2031. So this resignation comes much before that tenure was supposed to end. He was appointed as GCPL's MD and CEO on October 18 of 2021, and in his resignation letter addressed to Nisaba Godrej, he has said that since the day of his announcement as MD and CEO all the way back in 2021, the shareholder return has been 10% compared to the Nifty FMCG index return of 8%. 97% of an analysts have either a buy or hold on the stock, which is the highest rating amid the sector. He has also said, and I quote, "The task I had set for myself here is done, and this is the right time to move on. Would be happy to fully support my successor through this transition period." That is the verbiage that he has used in his letter. Now let's just understand a little bit about Godrej Consumer Products under the leadership of Mr. Sitapati. The stock price on October 18, 2021 was 1017. Latest stock price is 1025. No move absolutely at all in all of these years. Volume growth, however, has done pretty well from almost flat when he took charge to 6% now. It peaked in Q4 FY24 when it reached 12%, and it has slightly moderated from there. A little bit about the incoming MD and CEO, Mr. Asif Malbari, who's the current global CFO of the company. He's a chartered accountant and company secretary by qualification. He has spent 3 decades in the FMCG and auto industry, and prior to GCPL, he was at Tata Motors as well as HUL. And recently, he has played a very important instrumental role in the transformation of Godrej's Africa business. And a little bit about the incoming CFO, the interim CFO, Mr. Vishal Kedia. He's been with the Godrej Group since November of 2016, currently leads the global strategy, financial planning and analysis and investor relations at GCPL, was at BCG, the Boston Consulting Group, before joining GCPL, and he is an alumnus of the PGDM program from IIM Ahmedabad. So this in a nutshell sums up the kind of change of guard that we've seen coming in at Godrej Consumer Products. Revenue when Mr. Sitapati took over in FY22 was at 12,276 crores. Latest FY26 revenue at 15,178 crores, giving an absolute return of about 24% and a CAGR return of close to 4.5% in the last 5 years. So that sums up the kind of move that Godrej Consumers has seen under the leadership of Mr. Sitapati, who has resigned with effect immediately.
Moving on, India's tax collections continue to show strong momentum in FY27. As of August 10th, gross direct tax collections have crossed 9.5 lakh crore rupees, rising nearly 20% year-on-year. Corporate and non-corporate taxes have also seen growth. My colleague Kuldeep joins us with more details on these numbers.
Well, the gross direct tax collection stands at 9.54 lakh crore rupees as on August 10th of the ongoing financial year, and it recorded a growth of 19.75% year-on-year. The data shared by the Ministry of Finance, Department of Revenue further stated that the net direct tax collection stands at 8.11 lakh crore and the growth is 23.09%. Now talking about the corporate and non-corporate tax collections, so net corporate tax collection was at rupees 2.70 lakh crore and here we are seeing a growth of 19.8%, while the net non-corporate tax collection is 5.07 lakh crore and the growth here is 23.4%. Well, as per tax experts, the data shows strong growth in gross non-corporate taxes and STT collections and a slowdown in refunds. So because of this slowdown in refunds, we are seeing nearly 23% growth in the net collections. And in fact, the tax experts have stated that it is expected that the pace of refunds will increase over the next few months. So this is the data released by the Ministry of Finance, Department of Revenue as on August 10th of the ongoing financial year.
Well, on this note, it is time for us to slip into a very short break. You don't go anywhere. We'll be right back on Business at 9.
Welcome back. You're watching Business at 9 with Shibani in our Mumbai studios and me, Jude Sanath, coming to you from Chennai. Let's move on to a piece of breaking news action that took form and shape a little while ago. Talks, we're told, have been fruitful between the Bengaluru chapter of the National Restaurant Association of India as well as Swiggy. Remember, as we have been reporting over the last couple of weeks, the Bengaluru Restaurant Association has been chatting up and discussing its recent note of discord with delivery apps including Swiggy and Zomato. As per the latest developments broken right here and first on ET Now, an OTP system will be brought in place so as to ensure that restaurants have full consent over discounts being applied by these apps, even as standardized commissions per restaurant has been proposed to be introduced so as to ensure that restaurants don't see sky-high costs by way of these apps' sky-high commissions. In fact, let's take a look at what Anant Narayanan, the head of NRAI Bengaluru, had to say to ET Now.
There's been very good response by Swiggy CEO, Zomato CEO. The teams have been wonderful in listening to many of us. They've assured us that most of the problems would be solved. They've taken a little extended deadline. I think more or less this should close the bone of contention issues between us. Discounted one is a lot of error happening in the system, error happening by the people in the system. I don't know deliberately or why it's happening. It's happened. So they have come up with a OTP-based discount system where without the OTP, discounts would not be coming onto restaurants. More or less, if this is looked into, worked on, then I think the problem solved.
Right, now moving on, an Indian currency is set to enter the Polymer era with 10 and 20 Polymer notes receiving a nod from Rajya Sabha. The move could have implications not just for the durability and handling of the currency. ET Now's Akanksha spoke to Saili S. Nair, MD and CEO of Tamil Nadu Mercantile Bank to understand what the shift to Polymer notes could mean for banks from cash handling to currency management. Let's listen in.
It would not have a significant impact. But from a cost perspective for RBI, I'm sure it's going to have a huge impact because, in second round of it, it all gets soiled and needs to be replaced. The printing cost, etc., is way too heavy. From that angle, the longevity of the polymer currency notes is up to 10 years. So from that angle, it's going to save a lot for the economy. The 10-year longevity that the currency will have will save the reprinting time and again, right? From a cash holding perspective, 10 and 20 may not have that much of an impact as would the 100, 200 or 500 will have. Yeah.
So on FCNRB deposits, how much do you expect that the bank will mobilize until the scheme ends?
I'm from Tamil Nadu Mercantile Bank and we don't have that kind of linkages outside. I think we realize that this is a divisions area for us and that we will correct it going forward in the next 2 years. But having said that, we are still looking at raising FCNRB from our existing customers and we're targeting them about $50 million. Yes, not that big a player. The $50 million, certainly we will be there by the 30th of September.
And a parliamentary health committee has reportedly recommended capping private hospital room charges in metros at the rates of nearby three-star hotels. Now, the proposal is not yet government policy or a mandatory cap, but is certainly being considered. My colleague Kuldeep joins us with more details.
Well, taking note of exorbitant fees being charged by private hospitals, the Parliamentary Standing Committee on Health and Family Welfare has recommended that hospital room charges should not exceed average tariff in three-star hotels. The committee submitted its 176th report in the Rajya Sabha. In the report, the committee noted that some private hospitals charge large amounts for hospital stays, especially in metropolitan areas. It further noted that rationalizing of room charges needs to be done on an emergent basis, and it recommended the union government for making this benchmark mandatory for all private hospitals in large metropolitan cities. In the report, the committee further noted that the hospital room charges are not uniform and vary across geographic regions, even among hospitals within the same area due to differences in infrastructure, service levels and operating costs. The committee also recommended that the resident doctor cost, nursing costs, disposable costs of consumables, meal charges, laundry charges can be added to the basic room tariff so that the entire cost is rationalized. So this is the recommendation of Parliamentary Standing Committee on Health and Family Welfare. The committee submitted its report last week, tabled the report last week in the Rajya Sabha. And the report contains more than 360 pages, and in the report the committee flagged the concern over the exorbitant fees being charged by private hospitals for the stays, and now the committee has recommended the government that the room charges, hospital stays should not exceed average tariff in three-star hotels in the vicinity of that hospital.
Well, with that, it's a wrap on this edition of Business at 9. Goodbye from me, Shubhani Gharat, my colleague Jude Sanit, and the entire team of ET Now.